This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street, recorded Monday, August 18th, 2014. I'm Lee Adler, and we're going to look today at some of the data on bank lending, which many of the pundits have been complaining about wrongly and misunderstanding and misrepresenting. But first, the big question with this rally we have today in the market up about 15 points here at 2:45 in the afternoon in New York. The question is, when does this end? And the answer is when the Fed decides it's going to end. And that doesn't mean that the Fed decides it wants a bear market, but the Fed decides that it's going to pull the punch bowl for a while. We saw that in 2007 when it stopped growing its system open market account, its asset base, early in 2007. And through the latter part of the year until things started to fall apart and they began to panic. But once the Fed stops, that's enough to reverse the momentum and get the ball rolling downhill. I went back and took a look at some Fed data that I found from pre-2002 before it began publishing its daily open market operations and the weekly data on the H41. And it turns out that we have some weekly data going back to 1996. So I looked at the top in 2000. It's very interesting. Just prior to the end of 1999, when everybody was worried about the Y2K bug, the Fed flooded the system with liquidity in December of 1999. Then, when it was apparent that there was no crisis, it withdrew all of that liquidity. At that time, it was a record amount of liquidity pumped into the system over the course of a month. In January, it withdrew every dollar of that. But rather than resuming the steady 8% growth that it had pursued for several years before that, and 8% is pretty extreme and had a lot to do with why we had a bull market for as long as we did. But rather than doing that, the Fed decided that it was going to pull the punch bowl. It had seen enough of the internet bubble and the tech bubble and the threat of inflation, of consumer inflation, that it pulled the punch bowl and it stopped growing its balance sheet completely throughout most of the year 2000. And that was enough to cut the bloom off the rose and get the momentum reversed and heading in the other direction. Of course, at that time, they were also raising interest rates. But stopping the growth of the balance sheet was the first step. Now, here we have in 2014, the Fed has decided to end quantitative easing, and it will pretty much end by the end of the year. It will continue to do some limited purchases of mortgage-backed securities to replace those that are being paid down off its balance sheet. That'll keep its balance sheet level, but more importantly, it'll pump new money into the accounts of the primary dealers at the rate of 15 to 20 billion a month. So they're not going to end QE completely, but pretty much shut it down to the point where they feel that that's as far as they can go at this point. Now, in addition to that 15 billion a month or so, the Fed has a partner in crime, that being the Bank of Japan, which is pumping into the very same dealer accounts, in addition to some others, but mostly into the same dealer accounts, somewhere on the order of the equivalent of about 80 billion, 70 or 80 or 60 or 80 billion US dollars per month. And we just don't know. We haven't really seen that before, where the Bank of Japan was acting as a lone wolf in supporting the system while the Fed and the ECB sat on its hands. We don't know what impact that's going to have next year. But I think that the Fed pulling back its horns as much as it plans to will have a destabilizing effect on the markets. And I think that looking forward to 2015, that we're going to see an end to this more or less straight up bull market, and we're going to start to see some larger corrections at that point. I think in order to have a full-fledged bear market, we're going to need to see the Bank of Japan no longer acting as the Lone Ranger and in some respects pulling back its horns. What happens if the Fed comes back, if they see enough of a sell-off in stocks that they come back and start pumping again? That's anybody's guess. We really don't know whether the markets will take off again at that point, whether we'll see consumer inflation, whether we'll see the bubble expand even further. All we know is that the environment is going to be different in 2015 than it is today. Okay, so the issue about lending. I was very annoyed by an article published by MarketWatch this weekend, written by Rex Nutting, who is one of the absolute worst of the financial journalists when it comes to misstating the facts, twisting them, misunderstanding them, misrepresenting them. I mean, there are so many journalists that simply don't have a grasp or don't have any interest in reporting the facts as they are. And the complaint has been that there's not enough lending, there's not enough borrowing, there's not enough credit expansion, and the economy, therefore, is sluggish and more people aren't going back to work. Well, in fact, nothing can be further from the truth. The lending that has been going on, however, has been of the nature of financial engineering and speculation and stock buybacks and of that nature. There's very little lending that goes on to increase production because, frankly, there isn't enough consumer demand for it. Ben Bernanke's trickle-down has pooled at the top, and they're not enough to cause the bubble to expand sufficiently to increase the number, the quantity, and quality of jobs that are available. The jobs that are being created are lower-paying jobs, and more Americans are being left behind and unable to participate in economic growth. So we see the numbers growing, we see the economy, the totals growing, but we see more and more people that are not participating in that. A very limited slice of the American pie, a very limited slice of the American people are enjoying the benefits of this so-called growth. Everybody else is not participating. So let's take a look at how these loans are growing and where they're growing. First chart, bank loans ex repo lending to non-banks. Basically, this is all of the loans by commercial banks that we get from the Fed's weekly H8 statement that comes out on Friday night for Wednesday of the preceding week. So this is really almost real-time data. Why have I excluded repo lending? Repo lending is about 5% of total bank lending. However, it is extremely volatile, not only from week to week and month to month, but from year to year. So that, for example, in 2013, when the rest of bank lending was still increasing nicely, if we had included repo lending in here, that was negative as the banks were running away from the treasury market and defunding the carry trade. It would have made this line go slightly negative. So I've excluded repo lending from this line, but we'll take a look at that later along with some of the other components of total lending. Now, a lot of the pundits have been complaining that loan growth isn't fast enough, that the banks aren't lending, that people aren't borrowing. But as you can see, nothing could be further from the truth. We're now up to an annual growth rate of about 6% in total bank lending. Let's just take a look at a little bit of the history of this. Here's the credit bubble from 2002 to 2006 when the housing bubble topped out. But we still had a financial bubble going on in the securities market. Stocks didn't top out until the mid to latter part of 2007. And then we started to get into the desperation lending phase as the bad news started to come out in the second half of 2007. And the Fed began some of its emergency lending programs. So it was forwarding cash to these banks directly through some of these panic programs like the TAF and encouraging banks to continue to lend. And that went on through 2008. Then late in 2008, the banks acquired some assets from non-banks and we had another spike. So the total lending ended up topping out in late 2008. Actually, after the collapse was well underway and actually towards its latter stages. But that was all because all of this lending in 2008 was all lending that was funded by the Fed and other central banks, and it was all part of the panic situation. The bubble really topped out here in 2006 and 2007, and then you had the panic lending, the distress lending that took place all throughout here. Beginning in 2008, the deleveraging started. Late 2008, 2009. In 2010, the banks were required to bring special purpose loan vehicles back on the books. That's what this spike is all about. Those loans were always there. But the deleveraging trend was actually continuing and did not end until the second quarter of 2011. Now look what coincided with that. The first leg of QE1, the Fed's pause, and then it had QE2. So throughout QE1 and QE2, when the Fed's ostensible purpose was to stimulate lending, and it was also a zero interest rate policy at that time, as interest rates came down and as the Fed was doing QE, the banking system was deleveraging the whole time. ZIRP and QE did nothing initially to stimulate lending. When did lending start growing again? In the middle of 2011, which is exactly when the Fed went into its longest pause between mid-2011 and the end of 2012. They enacted QE3 and 4 in September and then actually began settling the purchases in November. But during that period when they were doing absolutely nothing, bank lending was picking up smartly and had risen to almost 5% by that point. That's when QE 3 and 4 kicked in, and then look what happens. Loan growth slows again. So the theory that QE and zero interest rates has stimulated bank lending is shown to be false by the fact that bank lending was actually shrinking during the periods when quantitative easing and ZIRP were most aggressive, and bank loans grew more during the period, the interregnum between QE2 and QE3 from middle of 2011 until the end of 2012. That's when loan growth was strengthening to its highest point by that time. Now the pundits are complaining that loan growth is again too slow. Here we are at the beginning of 2014, and loans had to slow down to a 2.5% growth rate. But considering that that's probably the economy's full potential growth, I mean, we have 1% population growth. Why would you expect the economy to grow faster than 2.5%? But at that point, the lending began to pick up again. And here we are in August of 2014, and loan growth is up to 6% on a year-to-year basis again, as the Fed begins to slow quantitative easing. So all those pundits who are talking about lending being too slow, like Rex Nutting in Sunday's Market Watch, a ridiculous post that he had up complaining that loan growth was too slow, you can see that it's actually accelerating and beginning to take off. Now, let's go back to 2006. This was the top of the housing bubble. Credit bubble really started to come apart in the middle of 2007. Total bank loans were at $6 trillion. Today, when supposedly there's not enough lending, total bank loans are now at $7.5 trillion. We're 20% higher now than we were at the top of the bubble. And even if you add on all this distressed lending here, about from the middle of 2007 at $625 billion to $700 billion, that's $75 billion in distressed lending. Even if you include that, we're even above that level. So those who complain that there's not enough lending are so far off the mark, it's ridiculous. In fact, we are in a bubble again, and we are in a record bubble even greater than the 2002 to 2007 leg of this massive credit bubble. Now let's take a look at some of the component lending to see just how dangerous this thing has become. One of Rex Nutting's complaints was that commercial lending was slow. He stated that commercial loans had only grown by $160 billion in the last 12 months. Only 160 billion. He neglected to state that that amounted to an 11% year-to-year growth rate. Now, 11%, if that's slow, I'd hate to see what they think is adequate growth. 11% seems like a pretty radical growth rate to me. So again, let's go over the history of commercial and industrial lending. There was somewhat of a retrenchment from 2002 to 2004. The stock market was in a bear market for a good deal of that time into early 2003. And there was some deleveraging going on, about a 10% cut in commercial and industrial loans. But then loan growth took off. From 2004 to 2008, from 2004 to 2007, when the credit bubble was really topping out, loans grew, commercial and industrial loans grew from just under 900 billion to almost 1.3 trillion. So you had a $400 billion increase on a $900 billion base, a growth rate of about 44% over the course of 3 years. And that, in fact, was an annual growth rate in 2005 of 15%, 15% in 2006, and a little under that, about 13% in 2007. Then the emergency lending phase began. The credit bubble was topping out. Things were falling apart. The Fed started its emergency loan programs and began funding the banks and everybody else and doing all kinds of direct lending to stave off disaster. And that's what this is. From the middle of 2007 to the end of 2008, we saw commercial and industrial loans grow from just under 1.3 trillion to 1.6 trillion, a growth rate of 20%. This is all emergency distress lending, which was basically funded by the Federal Reserve and other central banks. The bubble really topped out here at just under 1.3 trillion in 2007. We only got back to 1.2 trillion in 2010 after a couple years of deleveraging. Then the market started to firm up again, and here we go again. It's off to the races beginning in 2011, 2012, when the growth rate again approached 15% in commercial and industrial lending. There was a little bit of retrenchment in 2013, but here we go again. And by then, at the end of 2013, we're at the top of the bubble levels again. Remember, the bubble really topped out here at 1.25 trillion or so in 2007. We're way above that in 2012 and 2013. We're back to peak levels, and all of a sudden this year, we begin to go parabolic again. So we've added this year from 1.6 trillion to 1.75 trillion, about $150 billion in 6 months, which equates to an 11% year-to-year growth rate, but even more than that over the last 6 months. Over the last 6 months, commercial and industrial, well, I say 8 months. Over the last 8 months, we've gone from about 1.6 trillion to 1.75 trillion. So that's about a 9% gain in 8 months, which is, well, you do the math, that's going to take us up to about 12 or 13% on the year. For those who say that there isn't enough commercial lending, I have only one word for you: nuts. I said we would take a look at Fed funds and reverse repos. These are the loans that banks make to securities dealers and other financial institutions who then use those loans to finance their securities holdings. And this would include the carry trade of Treasury securities. So on this chart, you can see the scale is in the hundreds of billions. So it's actually in the millions, but the top of the scale is 375 billion, and the bottom of the scale is 150 billion. So it's very volatile. You can see a doubling or a dropping in half in no time at all. But as a percentage of total loans, keep in mind that the total bank lending is in excess of 7 trillion. So this only represents about 5% of total lending. But again, let's take a look at the history. You saw a steady increase in this repo lending from 2002 to 2007. Bubble topped out here in the middle of 2007. Then there was some emergency lending that went on from the second half of 2007 into 2008. And again here when the collapse was in full swing. Notice that as the deleveraging took place from 2008 to 2009, and the borrowers reduced their repo borrowings, they were also selling treasuries. The right-hand scale here is the inverse of the 10-year treasury yield. So this red line is the 10-year treasury yield on an inverse scale. So think of this as the price, the direction of the price of treasuries that was going steadily higher from 2007 to 2012 as the yields, of course, went down. So then in 2009 and 2010, this repo borrowing and lending activity stabilized, and then it started to increase in the middle of 2011, and this was when the Fed again was halting QE and went into a pause from middle of 2011 until almost the end of 2012. So QE was in a pause here, and the banks at that time started to increase their repo activities again. So here again is more evidence that QE and ZIRP, as opposed to stimulating lending, actually suppress it because the lending didn't increase until QE went into a pause in 2011. While the QE was at its most aggressive in 2009 and 2010, repo borrowing was coming down. And then again, what happened was at the end of 2012, the banks began to deleverage and unwind these carry trades. Throughout 2013, we saw a sharp rise in the 10-year treasury yield, a sharp decline in bond prices, and coincident with that was this deleveraging, this unwinding of the carry trade, and the reduction of repo borrowing from $360 billion or so down to about $260 billion. Almost a third of repo borrowing was retired during the year 2013. But again, look what's happened in 2014. Here we go again. They're borrowing to fund a treasury carry trade again. Beginning in January, we've gone from about $260 billion in repo and Fed fund borrowing up to about $310 billion, a $50 billion increase, about a 15% increase, funding this rally in the treasury market. So this is just speculative financial engineering here once again due to the Fed's ZIRP policy. Finally, I want to take a look at a category of lending, commercial bank lending, called other loans and leases. So the Fed defines this as including loans for purchasing or carrying securities, which would include margin lending to customer in addition to the longer-term loans other than Fed funds and reverse repos that finance securities dealers' holdings. In addition, it includes loans to finance agricultural production, loans to foreign governments and foreign banks, obligations of states and political subdivisions, loans to non-bank depository institutions and financial institutions, unplanned overdrafts, loans not elsewhere classified, and lease financing receivables. Now, back in the good old days, the Fed used to separate out loans for purchasing or carrying securities, in other words, margin lending, so that we could actually track margin lending on a real-time basis. Now we only get that from the New York Stock Exchange on a 2-month delayed basis. But this total other loans category is up about $900 billion here, and New York Stock Exchange margin is approximately around $460 billion as of June. So we can probably safely conclude that margin lending makes up about half of this trend here, and the rest of it is all this other garbage. Most of it's speculative, well, not most of it, but some of it's speculative, most of it quite risky, with possibly a couple of the governments and state and local, some of which are risky, but it is what it is. So this is other loans and leases, And as of now, it's up to $900 billion. So it's 12-15% of the total loans outstanding. Once again, I just want to call attention to the complaint that there's not enough borrowing out there. Well, there may not be a lot of consumer borrowing because consumers are tapped out. But there's certainly a lot of financial borrowing and a lot of speculation and a lot of financial engineering that's being financed by all this Fed funding money. Let's look at the history. From 2003 to 2008, we saw a massive uptrend. Again, the bubble topped out in mid-2007. And other loans and leases at that point had grown from, say, just under $400 billion, let's say around $380 billion, to about $550 billion, or somewhere around 40% growth over the 3-year period from 2003 to the middle of 2007 when the bubble topped out. Then we had our period of emergency crazy loans funded by the Fed, and here that went from $550 billion to about $710 billion. So $160 billion, or say 30% of these outstanding loans were funded by the Fed to keep the whole ball of wax from collapsing at that point. These are, let's call these the extend and pretend loans here. Most of them are still on the books, I would think. And then we had our period of deleveraging in 2008, 2009 through early 2010. Banks were forced to take some special purpose vehicles back on the books here. But all the nonsense started all over again, 2010, 2011. You see the growth rate come back above zero in 2011 and rise all the way to about a 14% year-to-year growth here in 2012. And that's when the party really got started, when we see this lending activity going parabolic. And we're now running at a growth rate of about 11%. So if this was a bubble, when we were at $550 billion in these other loans, what is it now that we're at $900 billion? My point all along in recent months has been that the U.S. economy is overheated in certain sectors, that it's extended, that we're in a bubble. And I think all of this data on the various types of bank loans that are outstanding certainly supports that conclusion. So that's our look behind the paper curtain of Wall Street propaganda this week. Hope it gives you some insight into what's really going on. This bubble is raging. I believe it's in the rigor mortis phase, the rigor mortis rally phase. And we may have a little higher to go in stocks before it ends, but I think the next couple of months it will end. It's going to be difficult to make money on the long side in the market, but I think it's probably still too early to be looking to taking positions on the short side. So that'll do it for this week. We'll get together again next Monday. That's Monday, August 25th. Until then, have a great week. Trade sane. I'll see you next week. This has been Radio Free Wall Street with Lee Adler. Find this program on the web at radiofreewallstreet.fm or wallstreetexaminer.com.